Hello, everyone. Today on this special edition of The Final Bar, we're going to focus on ratio analysis. I often talk about my macro toolkit is based on price and then breadth and then sentiment. But another key piece of my investment process using charts is using ratio analysis. This is my main way of differentiating between groups of stocks, different baskets of stocks, different themes, different market cap tiers, styles. Ratios are what tell you what is what. Ladies and gentlemen, this is The Final Bar. Hello, everyone, and welcome to this special edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets using the power of stock charts, using data visualization, momentum analysis, trend following, price, breadth, sentiment, and ratios. Today, we're going to focus on a particular part of my toolkit called ratio analysis. As I was learning technical analysis, my initial, observations were focused really on price itself, looking at a particular stock, a particular chart, looking at price over time and using a set of indicators and techniques to try to understand the trends, follow the trends, anticipate trend exhaustion. But as I went further on in my career, particularly when I worked at a large buy-side institution for a number of years, I found the real value of ratio analysis. This is something that institutions do often to relate different groups of stocks to each other, because it's not always just about what do you think of this particular stock. Let's look at Home Depot and analyze this particular chart. It's often, relating different charts to one another. It's focusing on growth versus value, small cap versus large cap, non-US versus US, consumer discretionary versus consumer staples. We can go on and on about all the different ways we can compare different baskets of stocks to one another. So what I wanted to do with this particular episode is to focus on ratio analysis, look at a number of examples, talk about why we relate stocks, relate groups of names to one another, and then I'll show you my ratio analysis chart list that is part of my my chart pack that you can get for free on StockCharts.com. I'll show you how to access it, and then we'll walk through some of the charts in that list and focus on the messages that we're seeing here as we record this in late February. So what is ratio analysis? We're looking at a chart of Home Depot. At the bottom, we are doing a very simple form of ratio analysis, which is the ratio of Home Depot versus the S&P. Relative strength for me is a key part of the toolkit, and it tells you how a stock does relative to other stocks. So when this ratio line is going up, Home Depot is outperforming the S&P. When it's going sideways, it's performing in line with the S&P, and when it's going down, it's underperforming the S&P. So simply by looking at a ratio of one stock versus a group of other stocks, and looking at when this line is going up or down, you can get a basic evaluation of when Home Depot is outperforming, when it's a market performer, or it's sideways relative to the market, and when it's underperforming the S&P. And in general, right, the general idea is owning, if you want to outperform the S&P 500, you should own stocks that are outperforming the S&P 500. My friend Tom Bowley from Earnings Beats first mentioned that phrase to me. I thought it was fantastic. Another way that I've thought of it, this is from John Roque, who's a longtime technical analyst at the Texas Blyschroeder, and then went on to a successful career on the buy side at a number of hedge funds. He used a baseball analogy and said, if you were, managing a baseball team, and you wanted to try and win the championship, would you put your top players on the field, or would you take the guys from the bench and put them out there? And as investors, why would we expect to outperform by putting a bunch of inferior performers on our in our portfolio, right, in the big game? You want to put your best lineup, put your best players out there, and that's why you lean into your relative winners and lean away from your relative losers. Now, relative strength, looking at the stock versus the benchmark, is just one form of ratio analysis. And this is the chart list that we're going to spend most of this episode focusing on. It's called ratios, and it goes through a series of comparisons of one basket of stocks to another. And they're in a particular order that we'll talk through, and I'm happy to share with you the different ratios and what they mean. How can you access this list? Well, the good news is if you use StockCharts, you can get to this very easily. Go to the member dashboard, and in the right side, you'll see chart lists. I have an insane number of these. It's on my list at some point to go through and clear some of these out because I've created quite a few. But if you get to the bottom, you'll see this gray button that says Manage Chart Packs. If you go down the list here, give me a second. If you go down the list, you will see one called David Keller's Morning Coffee Routine Chart Pack. You just click on Install. That will copy those into your login. So this is actually one of the chart lists. There's 13 chart lists that appear in this chart pack. Again, you can access it for free as long as you have a StockCharts login. Copy them to your own account. You are welcome to tweak them, adjust them, do whatever you want with them. They're yours to play around with. What I'll show you, what I'm working with, is the standard set that you're going to have when you first download that chart list. So this particular that chart pack. So this particular list is called 2300 ratios, and that's the one we're going to go through here today. We'll go through 10 per page, so we can go through all of them. And you'll see there's a couple different styles that I tend to use to compare them, but they're very simple charts, right? This is literally going to be a line or two, and it's all about the slope of these lines. It's all about how these lines are moving relative to one another. So the first one is looking at consumer, and the inspiration for this chart list came years ago. Bill Doan, who was one of my predecessors when I ran the Fidelity technical research team in Boston, he had run the group in the 70s and early 80s, and his comment, they had a classic chart, hand-drawn chart in the room, and it was called offense versus defense. And it used two indexes, which unfortunately became obsolete. They no longer updated them. And so we adapted that chart into one that looked kind of like this. And this is looking at just the ratio of the XLY versus the XLP. And this is an updated version of that chart we use. So it's simply looking at how within consumer, right? If you think of, an investor has an amount of money that they put just in the consumer space, and they're rotating back, leaning into the offensive side, consumer discretionary, or the defensive side, consumer staples. Which way are they leaning at any given point? And if this line is going higher, that tells you consumer discretionary is outperforming consumer staples. If the line starts going down, that tells you consumer discretionary is underperforming consumer staples. So it is a very simple measure of within the consumer space, what's performing better, the offensive side, discretionary, or the defensive side, staples. Now, the challenge with this ratio is that Amazon literally dwarfs the rest. If you look at Amazon, I haven't looked at the ratio or the percentages recently, but I think it's about 25% or so of the XLY is just Amazon. Home Depot is probably another 12 or 13%. So those two stocks make up over a third of the XLY, 40% or so. So if you're looking at this ratio, you're really looking in a lot of ways at Amazon's performance relative to other stocks. At the bottom, that's why we have an equal weighted version of that. So the RCD is an equal weighted consumer discretionary ETF. The RHS is a cap weighted consumer staples ETF. So this is the same ratio, but it's stripping out the overweight of Amazon and Home Depot. And it's literally looking at, you can think of it as more the average consumer discretionary stock versus the average consumer staple stock. Or to be honest with you, it's more looking at the entire basket and looking at them on an even basis. So what you've seen over the last year, really since the March low, and it bottomed out actually a little before the March 23rd market low, you can see that the ratios overall both have been sloping higher. And that speaks to the strength of consumer discretionary versus consumer staples. Now, depending on your time frame, there are times when that's actually not been the case. So if you look at mid to late June, you can see that the ratio on the top is still going higher, but the ratio on the bottom is actually going lower. This is when Amazon was still doing pretty well, but a lot of other consumer discretionary names not as strong as consumer staples. And so the equal weighted version starts sloping downwards. Now, just in the month of January to February of 2021, you can see a bit of a different take. Just recently, you can see how the ratio on the top has rolled over a little bit. That's because Amazon, Home Depot, down a good bit today that we actually are recording the video. You can see that the equal weighted version, though, sloping higher and still, just making new all-time highs in the last week or long-term highs for sure. So this tells you that weakness in Amazon, but overall, consumer discretionary is still performing very well on a relative basis to consumer staples. So overall, the general way that I use this is when this line is going higher, that tells you that in general, institutions are leaning more onto the offense versus defense, and overall, consumer discretionary outperforming consumer staples. That's more indicative of a bull market environment. The second one is a simple performance ratio of the semiconductor index versus the S&P 500. So I'm using the SMH which is a fairly common semiconductor ETF, and the SPY to represent the broad market, and literally looking at when this ratio is sloping upwards or sloping downwards. This ratio has been in a pretty strong cyclical uptrend for quite a while. You can see in like August to early September of last year, it started to broke down through its 50-day moving average. And this is when the market was going into its September peak. If you know the chart of the S&P, you had the peak in September, a secondary peak in October, and then you broke out to new highs in November, and it's been off to the races since then. You can see the ratio sloped downwards, and this was really when we were thinking of, looking at the emergence of energy and financials, things like industrials and materials. Is sort of, is this the end of the semiconductor trade, the FANG trade, right? Are these valued as a rotation into value? And from there, it sort of tapered off. Now, you still had strength in some of the value-oriented spaces, but semiconductors have continued to perform very, very well. Now, just in the last week, that ratio's come off a little bit, but you can see a number of periods where there's been a brief pullback of a week or so, and then the ratio has continued higher. Semiconductors, the reason why this is part of this ratios list is I think of semiconductors as sort of a bellwether group. This group tends to do well in bull market phases. It tends to do a little poorly or less good during bear market phases. So that group doing well is one of those check marks in the plus column for an overall bullish take on the market environment. Overall, we're still seeing a pattern of higher highs and higher lows in that ratio, which overall is very constructive. If and when this makes a new swing low, if and when the ratio gets below its 50-day moving average, that would cause me to rethink that a little bit and think more about getting more defensive overall. The third ratio is looking at a particular part of the growth versus value trade. This is actually looking at financials versus technology, the XLF over the XOK. This is a fascinating chart. And if you go back years and years, another version of this chart I have actually goes back, a couple decades. And what's interesting about this is really for a long time, for many, many years, financials have been underperforming technology. This is not a new phenomenon. 2020, the XLF definitely underperformed the XOK, but that is the latest in a series of years where that's been the case. But look at how this ratio has reverted back higher. If you start at the September market peak, since then, financials have been a fantastic bet over technology. If you bought financials and shorted technology over the last 6 months, it's actually a pretty decent trade. It's actually pretty good. So where this tells you is this potentially is a huge sea change where financials are actually performing well relative to technology. Now, it doesn't mean to say that technology still can't outperform the S&P. Both of these sectors could. But in terms of looking at one versus the other, this is an unusual pattern to see a rotation into financials. Now, this tells you about the strength in the weakness in bonds, really, the rise in interest rates. It talks about the steepening of the yield curve. These are the things that will cause this ratio to continue to go higher. And so continue to higher rate environment, steepening of the yield curve, you will see this ratio most likely continue to go higher. But it's interesting because so many investors, so many of us for so long are used to financials underperforming. We may be at that condition where it totally changes. Now, another ratio to think about the financial sector is this one, which is looking at regional banks versus banks, KRE over KBE. Now, again, this has implications for a lot of different things, but it's really a measure of more offense within financials versus a little more defense within financials. Are people stepping on the gas of the smaller cap regional banks versus the mega cap banking index, the KBE? So the KBE is things like JP Morgan, other mega cap financial stocks. The KRE, more like Huntington Banks, Key Bank, and things like that, more mid cap and even some smaller cap stocks. So this is going to look pretty similar probably to the small cap versus large cap ratio, because you're basically doing a relationship of the smaller banks versus the larger banks. So what does this tell you? Well, you can see this is a chart going back for about 3 years. Look at how this ratio has exploded to the upside just in the last 6 months. For the 2 years, really the year and a half from early 2019 to really October, November of 2020, this is pretty much in lockstep. Both of these groups were not doing particularly well on a relative basis. But look at how since the September, really the October secondary peak in the S&P 500, look at how that ratio has exploded to the upside. Regional banks really were written off, and justifiably so, because of their struggling performance on a relative basis. But that ratio has clearly been favoring regional banks for a while. So while the ratio has certainly gone to new multi-year highs, The goal with ratio analysis to focus back here, focus on when these ratios first emerge, when it's making a new high for the last 3 months, the last 6 months, the last 12 months. So could this ratio continue to go higher? Absolutely, and I wouldn't be surprised if it does. But it's worth noting that it's already, there's been a pretty good run of outperformance for regional banks so far. The next one is another relationship from technology to other parts of the market. These are the Qs over the diamonds, QQQ versus the DIA. And I'm doing the same thing. I'm doing the ratio at the top, and then at the bottom, I just have a chart of the S&P 500 just to visually remind myself of what the S&P is doing versus what this ratio is doing. And I should take a moment here to just show some of the different ways that we're putting some of these charts together. We're going to take a quick commercial break. We'll come back and I will share with you how I'm actually setting up some of these charts, a couple different ways we can do it, and how we're using the ratio analysis, allowing us to compare two different tickers as an easy way to try to differentiate those two. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good for you to join us every weekday after the close for our show. We would love to hear from you, feedback on our show, feedback on your host, feedback on any of our guests, and also, and even more importantly, your questions that are coming up in your regular process of analyzing charts. Things you see on other shows on StockCharts TV, things you see from other places. No question is out of bounds. Let us know what you're running into in terms of technical analysis, charting, market dynamics, investor psychology, whatever it is. A couple ways to get your questions to us. Number one, via email, thefinalbar@stockcharts.com. Number two, on our Twitter, just tag us in a comment at FinalBarSCTV. Finally, on our YouTube channel, just put a comment below the video that you're watching. We would love to hear from you. Send your questions our way, and we'll do our best to answer your questions in our next mailbag segment. We're continuing our discussion today on ratio analysis. I'm digging in a little deeper on some of the ratios that I like to refer to pretty regularly. And this is part of a weekly routine that I do. And often during the trading day, I'm referring to them just to see what sort of movements that I can focus on. I did want to take a moment here as we come out of the break to focus on how I'm constructing some of these charts. So first off, all of these charts, as I mentioned, are part of the chart pack called David Keller's Morning Coffee Routine. Go to your member dashboard. You can download this chart pack for free into your login. Mess with the charts, tweak them, do whatever you want with them. You are welcome to all of them. But if you want to create something like this on your own, here's how you do it. There are just a couple quick tools that we use to create all these charts. And I just have a bunch of different setups that I like to do. Some I'm splitting the chart into two different ratios, like I'm doing on a previous chart. Here, I'm actually doing a ratio on the top and just showing the S&P on the bottom so I can visually look at the ratio and think about what that means for bull market phases and bear market phases. Does this ratio tend to go up or down in relationship to what the market overall is doing? And are there times when that changes, right? Is that relationship changing over time? So how do we do it? Well, first, to compare any two symbols, just do the first symbol, the colon, and then the second symbol. That works with anything, with ETFs, with stocks, with indexes. Just make sure you use the dollar sign, obviously, or the exclamation point in front of the indexes as needed. But you can do a ratio of any two securities of any sort, and you can immediately do it. When you do that, you can use a couple different ways. I usually use the solid line chart. You can also use the performance chart. That's sort of up to you, preference things in terms of which one you would want to use. Here, I'm just using a ratio because I'm not that worried about the actual values. I just want to know when the ratio is going up or going down. I tend to make the colors pretty simple, so I make them just all black or all blue or something like that to do it. At the bottom, if you want to create a second panel and have just the S&P, for example, just make an indicator called price and put the ticker of the other thing you want to do. So a lot of times I'll do ticker price or the indicator price. For the ticker, I'll do $ SPX. You can mess with the height. So if I do a height of 1, that's going to mean an even distribution between that top panel and the price at the data series at the bottom. Using those two things that I showed you, you can create all sorts of different ratio charts, combining different combinations of any of the things that I've shown you so far today. But that's the basic set of tools that I use to create these charts. So continuing on, we're looking at the Qs versus the diamonds. This is basically looking very similar to looking at the relative strength of the XLK versus the S&P. You're looking at the technology sector versus other things. Now, the Qs, include other things, and the diamonds really are a group of mega cap stocks, not just industrials. There's big banks in there, big technology companies, obviously in the Dow 30. So overall, this ratio has been sloping higher, but it's not been a dramatic outperformer. And you can see that the ratio's really turned lower in the last couple weeks or so. So while the S&P has gone higher, it's not necessarily the technology sector alone that's been driving it. You can especially see that in November, December, January, right? Starting at the end of 2020 into the beginning of 2021. You can see how this ratio has essentially been sideways for November and December. So it wasn't just technology anymore. These are other stocks that were starting to really participate in the uptrend. So that's what that's telling me there. Here, similar sort of read. I'm doing consumer discretionary XLY versus consumer versus technology, the XLK. What's interesting here, these are both considered offense, right? If you look at the last year, or if you look over time, both of these I would bucket in the offensive category in terms of sectors relative to defensive things like utilities and REITs and consumer staples. What's interesting is over the last year, this ratio is a wash. You really haven't gained anything by owning one of these sectors over the other. They are literally bucketed together. They both have served as good offense. They both have underperformed for the most part in a down tape. There's no real opportunity to outperform one versus the other. The ratio of the momentum ETF MTUM versus the SPY essentially gives you a read on trend following and how well it's doing. When this ratio is going higher, that tells you on average, if you're buying good trends, you're probably continuing to outperform pretty well. When this ratio turns down, I've often found you get head fakes, right? Charts that break out start to revert lower. You get false breakouts, false breakdowns. The strategy is starting to be a little more challenging. You want to be a little more selective about what you're doing. Now, overall, because this basket tends to buy strong trends and stick with them, overall, you can see over the long term, this has been a pretty successful strategy, I think, by most measures. But you can see in this case, for the last week or two, the ratio's actually rolled over, which tells you there's a bit of a leadership rotation of sorts. Stocks that have been good leadership up until now may not be good leadership in the short term going forward. Here, we're going to start to get into some cap tiers. So here we're looking at small caps versus large caps, the IWM versus the S&P. You can see this ratio really starting at the September market peak has been accelerating to the upside, and that's certainly been the case. A similar read here, I'm doing the equal weighted S&P versus the cap weighted S&P. The way we do that is there's an equal weighted S&P ETF called RSP. It's from Invesco, so I'm doing the RSP ratio versus the SPY. You can see same thing. This ratio has been going higher. So both of those speak to the strength of the smaller companies versus the larger companies. A different way we can do that is by looking at high beta versus low volatility. If you're not familiar with beta, it's essentially a measure of volatility. A beta of 1 would be a stock that moves in a similar percent movement to the S&P. When the S&P moves 1%, that stock tends to move 1%. A beta above 1 tends to mean it has higher percent moves than the S&P. A beta below 1 would be lower percentage moves. So something like a utility stock tends to have a low beta. Something like a biotech stock tends to have a higher beta. So it's simply a measure of volatility. Maybe a measure of risk would be another way to say it. So high beta versus low vol really speak to the offense, the juice, the higher beta names versus the boring, sluggish, defensive, low volatility stocks like utilities. This ratio has been going higher for the last 4 months, which shows you offense over defense, risk on over risk off, and that's what that tells you. We're almost done here going through ratios. The next one is looking at small cap value versus large cap growth. This is an interesting ratio I was looking at, thinking of the FANG trade, and when financials and energy started to outperform in the third to fourth quarter of last year, I thought this was a great ratio to show how our small cap value stocks, some of the forgotten names that had been underperforming for so long, are they starting to outperform the large cap growth trade, the mega cap sort of FANG trade that we've been so comfortable with. And you can see indeed for the last 6 months, small cap value has vastly outperformed large cap growth. These are some of the energy and financial names, industrials and others that have really emerged. Here we're looking at Russell 1000, so larger companies, growth over value. This ratio has been sloping downwards. I've been hearing about the return of value for longer than I care to share with you. I'm starting to believe that that rotation is certainly happening. And you've seen that in the strength of things like the XLF, things like the XLE, relative weakness on things like technology and some consumer spaces. But we can certainly see that in that ratio. Growth had been outperforming value up until the market peak in September. Since then, value has been outperforming growth. So if you're not there yet at this point, given the movement in that ratio, it's certainly telling you to lean there. This is the S&P 500 growth versus value, very similar look, but I look at both of those ratios. This is an interesting one. So growth and value, a lot of companies actually are treated as both. They're double counted. They are in both the growth and value bucket. And think of it as like a big technology name like a Microsoft that's pretty established, but in some ways it's still bucketed under growth. There are pure growth and pure value indexes, and these ETFs, RPG and RPV, track those returns, and you can see even there the ratio has been sloping downwards for quite a while, certainly in the last 6 months. So value over growth certainly seems to be the story. Now we're getting into some non-US markets very quickly. EM over EFA. We can see for the longest time EM has been doing very well. Just in the last week, we're seeing a bit of a mean reversion in that ratio. So overall, the long-term trend has been favoring emerging markets on the strength in commodities. That ratio is coming down a little bit. Here we're looking at US versus non-US stocks. So US versus essentially the world. The S&P over ACWI, ACWI, which is an ETF that basically tracks a global index, which does include the US, but it's a pretty good measure of just the US versus everything else. This ratio going down means the US has been underperforming, which speaks to the weakness in the dollar and what's been happening there. The ratio of stocks versus bonds has clearly been favoring stocks, SPY over the TLT. And so this ratio, starting at the March 2020 low, certainly you've been leaning into equities over bonds. Now, further on, we don't have time to go any further on my ratio list, but I would encourage you to do it. Things we would look at beyond this would be things like copper versus gold, stocks versus gold, different sort of big picture relationships, and finally, base metals versus precious metals, things that speak to economic expansion versus safe havens like precious metals. All of these ratios, if you think about what all these different ratios mean, there are different ways of evaluating baskets of stocks. What types of stocks are people leaning into and leaning away from? If I had a choice, a binary decision of one sector versus another, these ratios help you think about what that relationship might be. I would stress with you, I would rarely make a decision, I should say, based on one of these charts on their own. So for example, if I'm looking at base metals versus precious metals, I can see it's been clearly rotating more towards base metals, the industrial metals versus precious metals. I wouldn't make a decision purely on that. What this would tell me to do is then go to review the charts of silver and gold to understand more about the technical aspects of where gold and silver may be at, and then also look at things like copper and aluminum to focus more on industrial metals, base metals, and see what I can tell from that. So the ratios often tell me what charts I should be looking at. It's hard for me to use them as a conclusion on their own, because at the end of the day, I want to focus on charts and particular levels and signals I can evaluate from there. Folks, that is our show for today. Thanks for joining me on the special edition of the Final Bar, focusing on ratio analysis. I hope this helps you think about your own way of analyzing ratios and comparing different baskets of stocks. If you have any questions, shoot it to our email, thefinalbar@stockcharts.com. We'd love to answer one of your questions on the air. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.